All right, well, let us get started. Welcome to this workshop for today. Just double checking everything. Okay, so yeah, welcome to the workshop. So we're going to dive into the power of butterflies and long condors. So these are just two really great trading strategies and strategies to use. So I'm glad you're here, and I love these Saturday events. So we can just kind of kick back. Markets are closed. We don't have to kind of have the noise of the market surround us, so we can just be focused here today on two really dynamic option strategies: the butterfly and the long condor. And it's interactive, so if you have questions, make sure to ask. If I miss your question or something, and the GoToWebinars kind of scrolls down, and so they kind of roll off. But put it back in again. I'd be happy to address it. So really appreciate you being here. So a little background on myself. I started my trading journey back in the 80s with a company called Coastal Corporation. They were a large integrated oil company, and they had refineries and gas pipelines. They just pretty much covered it all. And at that time they had a training program that would actually bring people in and train you how to trade crude or oil products. So I was fortunate to get my foot in the door and got accepted into that program. And what they first would do would they sent me down to their refinery. They had a big refinery down in Corpus Christi, Texas, and sent me down there for about 3 months. And it was really good because they kind of wanted to get you the foundation of oil and how it worked, and bringing in oil tankers into the refinery, offloading that into the refineries, distillation systems, and producing products, and then taking those. So really great experience to kind of get you grounded. And then ended up in the shipping department, chartering tankers and doing all that stuff, scheduling, which was fantastic to kind of learn the nuts and bolts about how everything, the transportation worked. And then eventually was sent out to Singapore for a couple of years and traded actually oil products and all the Asian crudes. So fantastic experience there. So if you ever get a chance to visit Singapore, make sure you do, because it is a beautiful city. The food there is just the best. So spent some time there, trading oil and oil products, and then eventually the big opportunity came, and I was hired by a company called Trans World Oil, which at that time it was the largest oil trading company in the world. It was Trans World, Fibro, and Mark Rich. They were the three big major oil trading companies, and we were just involved in all the different energy sectors, and then eventually into all foreign exchange and all the futures. So spent about 17 years there. Was with them in Bermuda for about 16 years, and ended up running the international trading desk for 10 years out of Bermuda. And that's where everything really started developing for me, as far as just looking at all the markets, because we were in all the different markets, big in all the energy side, but we also were into foreign exchange and all the different futures markets. And then started trading options on cargoes of crude oil actually back in like 1987. So that was my first kind of journey and entry into the oil and option kind of program of the market. So that was fascinating. Never looked back after experiencing how to incorporate options in your trading, and so went on from there. So just a little background there, and appreciate everybody being here. So let us get started. So the following workshop today is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice and should not be recommended as a recommendation. So, like I mentioned, I've been trading options now for over 30 years. And what I found that the most valuable kind of go-to option strategies that can, literally help any trader or investor more than other strategies known. And especially when we get into times of extreme market uncertainty. We've been pretty fortunate here for the last couple of months, I guess. We've not had that super extreme uncertainty, but it's always just around the corner. We never know when it's going to pop out. But with the option butterfly and long condor, we can trade this with any kind of market environment. But it's really, really a great strategy when you get in really high volatility, uncertain markets. So it's kind of what I call my trading secret weapon. Now, because they're structured to require only a really small amount of your hard-earned capital, this really gives you some fantastic trading returns and explosive returns. And it's like, collecting or capturing that lightning in the bottle. My first, boss when I went to work at Coastal Corporation, he was a pretty crazy kind of guy, but he would get so excited when we have a fantastic trade. He'd say, "Man, I'd like to, bottle this up. It's like lightning in a bottle." So I've never kind of forgotten that phrase. And so it really is, when you have a great trade, you just kind of want to bottle it up and just repeat that trade each and every time. Now, the huge advantage that these strategies have is their unique option framework. So it's kind of designed to really take advantage of, time decay and also volatility. Now, those are the two main option pricing components, and these can then be used in any type of market environment. So it makes them great for a really favorite strategy for any market. But again, when we get in that certain uncertainty, these really come in really handy, and they really kind of become the go-to strategy. But it all comes down to knowing when, then, and how to use these two option strategies. Now, the thing that they can do is they can really help to take the work and they can work like in any kind of market cycle. So it could be an uptrend, downtrend, or sideways market environment. Really helps to take the unsettling guesswork out of your trading, eliminates the stress of having to be perfect on the stock's direction or overall market, eliminates that time decay expense that you're going to encounter from your long decaying options, and that's a really big benefit of these strategies. Now, they can also be structured for very low costs, and they give you a fantastic low, not low capital at risk, but high, capital at return with that low risk. Now, these strategies, or especially the butterfly, can offer you, returns of 20 to 1. Now, to point out, of all the different option spread strategies that are out there, the butterfly spread will actually give you the highest return on capital. So you can literally make, 20 to 1 or even higher. So we'll go through some examples, and I'll show you, how that can work and how you get these type of returns from the butterfly. So they're pretty amazing, pretty exciting two spreads. Now, the butterfly and the long condors can also be used when you're matching a trade up, so they're great for hedging. And they're kind of a really fast, low-cost way to cover your what pronto when a position starts to move against you. And I've literally found no other hedging strategy that comes close. So in this kind of market environment, it's a real game changer when you get into a position where you need that additional help and that hedge, and you need to put it on quickly. These are two ways that you can really go about that. And manage your trades in a fast manner to neutralize them and also reduce your cost of the trade. So, when you're constructing or a butterfly or long condor around a strike that becomes under pressure from, another core trade position. So let's say you had on a credit spread, or maybe you had a debit spread on, a vertical debit spread, and it's starting to maybe go against you, and you feel like you really need to kind of limit and reduce your risk. So you can do this really fast with either adding a butterfly or condor around that position. And what it does, it's going to first will neutralize your risk, okay? But it's going to also then lower your risk by adding additional, basically credit spread to your trade. And I had one member, Pam, she said, "I wish I'd known how to do this hedging before I lost so much money on credit spreads." So, that's a real, problem that you will encounter when you do credit spreads, is that they can be going great. You're making a really good, consistent returns, but every now and then you're going to have that one position that moves into that short strike, and that can really ruin, all the other really great trades. So, I'll show you a couple, detailed examples of how you can, incorporate this to kind of get around that potential problem with credit spreads or even debit spreads that you have, some risk that you want to reduce. Now, they're kind of a simplistic strategy when you break it down. So let's take a look at the construction of a butterfly real quick. So basically, this is a really good example. Let's say you're long a call, and then you're short a call. Okay, so if you're long a call here, and this is at 10:10, and then you're short the call against it at 10:20. So that's what we call a vertical call debit spread. So we can do this with calls, or we can do it with puts. Now, by doing a vertical call debit spread, what you're going to do is your profit, you're reducing your capital at risk by adding that short call. That's going to cap your, your upside return, but it's also going to cap your loss. Now, with this kind of trade, you're going to, in this example, your risk is your debit paid of $300. All right, so, at expiration, if it closes over in this example, that 1020, you're going to make your max profit. Now, if you look at this 1010 minus 1020, that's a $10 wide spread. And with options, one option contract, remember, is equal to our equivalent to 100 shares. So this would be like a $1,000 wide spread. And the cost of this trade is the debit paid of $300. Now, the difference then is $700. Now, that would be your profit. So pretty decent return, if you get a move and you expire above that short strike of 1020, you're going to make $700 on $300 of risk. That's a really good, what we call a positive risk ratio. So, that's a good way to go. But if you wanted to reduce your risk even more, we could do that quickly, neutralizing the risk and reducing the risk by adding a credit spread to this trade. So by doing that, we're going to reduce the risk even more. So if I sell that 1010, 1020 short strike here, okay, and then I buy the 1030 to cap that risk, so I'm not naked short that call. That's also a $10 wide spread. And for that, $1,000 wide spread, I bring in that credit of $200, okay? So then my potential premium is what I've received, that's the profit, but then my potential risk is the difference between the spread width and the credit I received. So that's $800. So that's what we call a negative risk ratio. So I'm risking $800 to make $200. So, that's a credit spread. And sometimes you're thinking, why in the heck would I do that? But in this example, what we're doing is we're going to neutralize and reduce the risk from the debit spread by adding this credit spread to it. So what we've done is we've adjusted and made it into a butterfly. So now we've got our dollar wide or $100 or $1,000 wide spread here, $1,000 wide spread here. So this is what we call a balanced butterfly. But our risk went from the $300 debit to receiving that $200. So now our risk is only $100. And if we go out at the top of the tent right there, that would be our max profit. And we're risking $100 here. And this would give us a profit of $900. Okay, so we had that spread width of 1,000. Now we've only got $100 at risk. The difference is, our profit, and that would be your 900% return. So you're risking $1 to make $9. So that's the beauty of, incorporating this kind of strategy with your trading portfolio. Now we can do this with calls or puts. We can leg in, we can leg out, we can do it all at once. So there's a lot of flexibility to this kind of trade. Now the other one, I call this the cousin to the butterfly, and this is the long condor. So this is one that we do a whole lot of these, because these give us a lot of flexibility to give us a wider profit zone. All right, so instead of having to really thread that needle with the butterfly, we can widen out that profit zone, so it gives us this wider area. Now these are also going to give us a positive risk reward, risk ratio. They're also going to give us a positive theta, so no time decay. But we're going to get a wider profit zone. Now we're not going to have the biggest great returns on capital at risk, but typically on this you'll get 2-to-1 to 3-to-1 or 4-to-1 return on your risk. Whereas the butterfly, you can literally get 20-to-1, things like that. But the two together are just a great arsenal or strategies to add to your trading portfolio to come in handy in any kind of market environment. Now, the core concept that make the butterfly and long condor dynamic come down to, the two most important option factors, for option pricing is time decay again, which is measured by the Greek we call theta, and then implied volatility. And so these are the two components that affect the price of the option. So let's take a kind of a review of the core concept of this and the impact that it has on price of your option. Now, theta then tells us how much your option price will go down over time. So it's the rate of time decay of your stock option. And that expiration, that theta or your time decay component goes to 0. So there's no time left. So that's what we want to take advantage of, and that's what we do take advantage of when we put on either a butterfly or a long condor. So, for example, here, let's say we've got, XYZ and it's trading at $45, and we're looking for a move here to 43. Not a big move, but just a little bit move down in this example. So what we're going to look to do in a butterfly, we typically will go target our, the area that we're going to. So in this example, we're looking for the price to go to 43. So this would be the target for the butterfly or the body of the butterfly. So in this example, let's say we bought one contract of the September 44 put, and we paid $2.38. So, that would be $238, one option contracts, equivalent to 100 shares. So we would have a debit cost here of $238. And then what we're going to do is sell against it, the 43 put, and we're going to bring in $1.67 or 167 bucks. And then we're going to sell again that 43 put and then buy below that the 42 and pay $1.06 or 106. So now we've put on a narrow wing butterfly, okay? So this would be $1 wide. You can see the strike 44 less 43 is $1, 43 less 42. So that's a balanced $1 wide butterfly. Now here's our cost. So we've got that debit cost of $2.38. The debit cost here, the 42 put at $1.06, and then we brought in that premium of $1.67 two times 100. So on this spread, this butterfly here, now our total risk or cost on this trade is $10 per spread or per butterfly. That's it. Now the profit, then you just take that middle strike less your lower, so that's $1 wide spread less your cost of your trade. And so in this example, here you go, 43 less 42 less your 10 cents. So here's your profit. Your max profit would be 90 cents or $90, and that would be, a 900% return at you're receiving that 90 bucks on that risk of 10. So you're risking again $1 to make 9. So it's a really good positive risk ratio type of trade. So, this is what's so dynamic and exciting about this spread when you get it in the right circuit situation. Now, the next step is, how do you choose the best, butterfly or long condor strategy, for your trading goals and your, parameters that you're, trading with. And in my opinion, one major goal for every trader out there should be to select trades based on the, what's going to give you the most consistent positive return that gives you low defined risk and not always the greatest return. So what I'm always preaching, with my members and clients at Power Cycle Trading is, we're looking to hit singles and doubles. We look at the risk first, and then we look at the return on that risk. So we're constantly in the market looking for good setups, and we're looking for those singles, doubles, and then occasionally you're going to get that triple or big home run. And that's where you really can, maximize your trading results and increase your trading equity curve. But over the long haul, we want a good, defined risk trade. So hit those singles, doubles, and then occasionally you get that home run and you're just really getting that curve going up from the left to the right. Now, one of the best ways then to achieve this is you first need to know what the different option strategies are out there available, how they work, and then you want to pick the best one that suits your, profile as a trader in the market environment you're trading in. So, looking at your risk parameters and your profile would be, how much trading capital do you have? Like Brent might be trading with $1 million trading capital, and Mark might have, 5,000, or Brenda might have 5,000. So it's going to make a difference as to your risk profile. And then the other thing is, how aggressive are you as a trader? But the one thing that stands out when we go through the butterfly and the condor, you can do this with any size account. You could have an account size of $1,000, and you can do one contract. So you can do one contract as a small retail trader like ourselves, or you can do thousands of these contracts that hedge funds do, all the time using butterflies and condors. So they're a great flexible kind of trade strategy that's going to really help you in kind of, like I said, any market environment you're trading, but especially when you get into those high risk, high extreme markets. Now, this is what I call the butterfly family. So there are a lot of different variations of the butterfly. And so they all have that component, though, of selling time and volatility as part of the spread. So, looking at what we've got here, we've got, we could do butterflies with long calls or put. And so that's what we can do. We can do this is what I call a bounce butterfly. We can make that a really wide wing butterfly or a narrow wing butterfly. We'll go through a lot of examples here in a minute, but that's how we can, adjust our risk. We can make it really narrow or we make it really wide. All right, so the other things that we have with butterflies, we can do what we call a broken wing butterfly, sometimes referred to as skipped strike butterfly. And we can do that with calls or we can do it with puts. We can do an unbalanced or ratio butterfly. We can do a broken wing ratio butterfly. We can do the iron butterfly. We can do what we call the lotto butterfly. We've got what we've designed as a Batman butterfly. We've got a Batman and Robin butterfly. And then we've got butterfly hedging defense, just a whole nother category. Then we've got the other really great strategy, which is kind of an offshoot or cousin. We've got the long condor, and then we can do all the different kind of variations with a long condor. So we could do a broken wing long condor, ratio, etc. And then we've got all the hedging. So you can see here, you've got a lot of variations, but these can really help you in all the different market conditions that you might be, having to trade in. So they're dynamic. Now, before we go too far, I know today is, part of the Labor Day weekend, so you might be kicking off or leaving soon or early, but if you do, before you leave, I want to make sure you have this opportunity. Now, this next weekend, I'm going to be doing a really deep dive into these two strategies. So it's going to be next Saturday, we're going to do this kind of butterfly long condor kind of option masters course. And if you sign up today, let me give you the link. This course will be, you'll get 15% off. So it'll be, 167. Let me just get that link for you. I'll go through the kind of the details over here and then we'll continue on. So use this link here. And then when you copy or paste it, a butterfly, we can then adjust the risk with the wingspan, like I kind of touched on earlier. If we want to make a really narrow, keep it our risk really tight, we can do just a very narrow wing butterfly. All right, now we're going to have a potential huge return on capital if we hit that top of the 10 of the butterfly, if we nail it perfectly at expiration, but we're going to have super low risk if we're wrong. But if we really want to, make a bigger, wingspan and really give us a bigger profit zone, it's like if you're a butterfly collector, you're going to have an easier time collecting butterflies if you've got a big wide butterfly net than if you've got a really, narrow or net. So we can do the same thing with the butterfly. If we want to give a really big profit zone, we can make a really wide wing butterfly. So we have this big zone for profit. Now, we don't have to, if we hit it perfect, the top of the tent, we're going to get a huge return, but we're getting fantastic returns anywhere inside because the way that these things are structured. So we'll go through a number of examples so you can see exactly how this thing can work for you to benefit your trading with low capital risk and big returns on your capital. Now, the first one, let's take a look at a narrowing butterfly. And these are great for, pretty much anything, with good volume on the stocks are fantastic. We do these a lot with, all the ETFs, index options. So we can do these with SPY, QQQ, IWM, the Russell. We can do this with the Diamond. We can do this with the SPX, NDX. You can do these with futures. So you can do these, with anything you're trading, as long as there's decent volume, like you're, do for any of your option trades. So this is an example of one that we had with a narrowing butterfly. Now, these examples, everything that I'm going to use today will be either trades that we did in the trade room or with the alert service, okay? So here's an example of a really narrowing butterfly on the ETF SPY. Okay, so first off, just kind of go through it. Here, again, I like to use Fibonacci, and with this course, you get the Fibonacci price target mapping course. But here we've got that swing high to swing low. So we get our Fibonacci levels. We've got 382, 50%, and 618. So the 618 retracement is a really key Fibonacci level. So in this example, we were having SPY, and at that time it was trading at 267. And we're looking for just a small, not a big, huge move, but a targeted move into this area here, which was the 618 retracement. That was right around 273. And there's also a lot of option activity, some really good stuff here. And you can see back here, that's what we call price action. Okay, so there's this kind of support area based on price. So a really good target there at 273. So that was going to be the target that we're going to use, and that was going to be then the body of the butterfly. So here's the trade setup, what it looked like. So we had that trade, it was trading at 267. So we're going to target 273. So that was going to be the body of this butterfly. So narrow wing butterfly in this case, we did 272, 273, 273, 274. So you can see there's $1 between the strikes. All right, so very narrow, okay? But the reason for the narrow butterfly is because that risk then is super, super low. So the risk on this was a 10-cent debit, which would be $10. Now the profit potential is your spread width of $1, which is $100 per spread, less your cost of 10. So the potential profit, max profit, $90, that would be a 900% return. So here's your return on risk. You're risking $1 to make 9, fantastic positive risk ratio. In this example, 2 days later, we were up $70 per spread. That's a 700% return. All right, so these things have that potential to give you these huge returns because your capital is so low. And here's kind of what it was looking like going out. So we weren't perfect. We were pretty close to it. But you can see that that's also, there's a little time element still left in this trade, when we're taking off. So this went from, $10 or 10 cents to $80. So there's your spread profit of $70 per spread. And this is, taking advantage of that time decay component, volatility collapse, and giving you that high return on capital. Now with this one, we had just, like 4 contracts, but that, adds up fast. That's $280 profit, on that risk of 10, or $400 risk to, on this example, make 280. So very, very great trade set up when you're, in an environment where you really want to keep it tight, but you also want to have that potential for a good return. Now, the next one is the wide wing butterfly. So this is more, the way that we typically go are wide wing butterflies, because we're going to get a wider profit zone. So we can really get that net, bigger net, capture bigger profit zone of price action, right? So bigger, wider profit zone, again, going to be structured, defined risk, great for hedging. These are great for what we, look at our targeted directional swing trades. Okay, so every trade that we're doing, we do have a directional target, and then if we think it's appropriate, we'll do a butterfly, or we might end up with a condor or something like that. So really great for trading high volatility markets. There are a couple of reasons actually for that, because when you do get in a high volatility market, the markets are moving, really big wide ranges, you want to tighten up that risk. So we can really tighten that risk up with the butterfly, but we still have the potential for some big returns. Plus, when we get the higher implied volatility, that also jacks up the option premium, right? And so with the additional sell side component from the butterfly or condor, we're taking advantage of that additional implied volatility spike. So that really is a great benefit. Also really great trading or benefit for trading high price stocks. So, you're going to have certain situations where, hey, there's this one stock that's really trading great. You want to be in it, but it costs so much, you don't have the capital to trade it. But with the butterfly, you can do that. And I'll show you some examples there. Now, the trade duration on these butterflies and condors as well is typically, we're not going to go out too far. So we could do these with just 1 day or out about 2 weeks. So that's about 2 weeks is about as far out as I like to go on these, because of the way the structure is and the way they perform. They really get the biggest bang right towards the expiration. So if you go out too far, you're setting a trade up that's kind of dead money until you get into that week of expiration or a few days towards expiration. The other great thing, big, huge advantage is positive data, no time decay at all. So, think about, coming into a long weekend, you've got a trade on that's a long calls or long puts, and you come back, the market does nothing, you come back in Tuesday, man, the thing's decayed like crazy. But with the butterfly, no time decay. The returns, like I said earlier, of all the different option spreads, the butterfly will give you the highest return on your capital at risk of any spread. So you can get 2 to 1, 10 to 1, 21 or higher, depends on the trade structure that you've done. So just so many different really positive benefits from the butterfly, the wide wing. Now here's an example of a wide wing butterfly on a short trade on QQQ, the ETF. And this then was using puts for a downside move. Okay, so when we're trading, let's think about it. If you're trading and you want to go long, how do you go long with options? You can either, buy calls or you can sell puts, right? So with a short trade, how do you go short with options? You can either sell a call, that's a short trade, or you can buy puts. So this is a short trade that we did with a wide wing butterfly, a put butterfly on QQQ. So this was going to be like $1,000 wide spread. So here's the trade setup going in, so you can kind of get an idea of what we were looking at here. So QQQ was trading about 314, and the market looked like it was going to start breaking down. You can see here we use our indicators. We had a cycle reversal here. Okay, now also let me point out, if you do want my indicators, these are the ones that I use all the time. That's also available in that package for $195 if you want to add it to your cart. So you're going to get this 5 steady set indicators. You've got my volatility squeeze indicator. You're going to get my momentum indicators here. So it's a great toolbox of strategies or studies to use. Okay. Now, so here's where it was trading. It was trading right here at 314, and it was like, this is what we call price action support. So it was looking like it was going to break. It kept chipping away. It looks like it's going to break it. So on this trade, what we did was a put butterfly, and we were having a target down here towards this area here, which was a price action support area right through there. Okay, and then there was this big 50 simple moving average down here. So we were going to target a downside move to 304, and we wanted to keep the risk though super low. So we did this with a butterfly, so a kind of a targeted butterfly. So here it was at 314.60, and then we were targeting down at that price point I showed you just a minute ago at 304. So we came out and we did this targeted trade, 314 long put, short the 304, okay, and then short that 304 put, long the 294. Okay, so we're not going to be naked. These are spreads, so we have no exposure to any naked call or put. All right, so this is, then you can see it's $10 wide, 314 less 04. Okay, so balance on both sides. So we did this $10 wide spread. The cost of the trade was $2.10, $210. All right, so spread width of $1,000 wide, less our cost of the trade, $210. That gives us the potential profit at expiration of $790 per spread. So if you did one spread, potential $790, your total risk $210. That's a 376% return. So you risk $1 to make $3.76. So positive risk ratio. Now, if you did this with ETFs, let's say you just shorted it, looking for that target at 304, you would have made, $10.60 per share, a 3.36% return versus this. You could potentially make 376% return on a lot less capital. So that's the beauty of it. So you can see here your total capital at risk 210, potential profit 790, and that's your profile of what you have on this trade. Now here's where it went out. We took the trade profit there. It was trading at that point. It was trading right here at $306. So not perfect, but very, very close. But this is a wide wing. So this gives you this big zone of profit. So even if you don't, we're not looking to nail it every time. Every now and then we get one that does nail it, so we get a huge boost. But we're just looking for low risk trades where we do have potential for a good positive return on that risk. Okay, so the big difference, if you're just doing credit spreads, right, you have a negative risk ratio. You're risking more than what you're going to make. And that's the thing that I don't like about credit spreads. But when we combine the two together, we have this potential dynamic structure where we have a risk in this example of $210, but we can make over 700 or 3, 4 to 1, right? So it's just such a much better way to go. Okay, so right here, boom. So this went from 210 to 782. So there's your profit there per spread was $572. Okay, that's a 272% return versus the share, if you did that, 3.6%. So there's just no comparison. So again, we're taking advantage of that time decay, volatility collapse, very low defined risk, your high return on capital. So just a really great structure, and you've got to, again, be using this if you're trading. Now, here's a really great example that I like to show on if you want to trade high price stocks and you have a super low at risk cost. All right, so this is going to be one to show you on Amazon. Plus, the other thing I'm going to point out is this will show you how this takes advantage of time decay volatility collapse going into close. All right, so a really good example to illustrate a couple of different examples of the dynamics and flexibility of the butterfly. So the first thing is the setup, what we were looking at. So Amazon at that time, when this was set up, this was back when Amazon was trading over $1,000. So it was trading at this point on the 29th of August, it was trading $1,782 per share, okay? So if you bought like one option contract's equivalent to 100 shares, okay, so to make that an analysis, an example, if you did one option contract, 100 shares. So if you were trading Amazon and you did 100 shares, you bought 100 shares, and it was priced at 1,782, your capital at risk that you're putting out for this trade would be $178,200. Okay, or maybe margined it, but you get 50% of that, but still a huge amount of capital that you're putting out to trade Amazon back at that point. So there are a lot of stocks that you might like to trade, but you just can't because it costs you too much. You can't afford it. But with the butterfly, here's what we could do. So we were targeting, it was sitting right on that 200-day moving average. We were targeting this number up here at 1830 based on our Fibonacci levels here. Some other things we were looking at, we had our momentum indicators were saying, okay, potential up. So our target was 1830, and it was trading down here at that 1780 level. Okay, so here's the trade that we set up to do this upside move. So if you bought the shares, you're going to be pumping out $178,200. But what we're going to do here, targeting that 1830, we went out and bought the 1820 call, sold the 1830, sold the 1830, bought the 1840. So you can see here it's a $10 wide spread between these strikes. So that's $10. That's a $1,000 wide spread on an option contract. Look at the cost of this trade. This cost 80 cents to set this trade up. So that's $80 per spread. That's the max risk. So for that, we've got the potential to make, if it goes out at our top of the tent, we've got the potential to make $920 per spread. If you did one spread, you make $920. Okay, if you did 10, you make $9,200. But that's how cheap it is, but that was on a risk of 80 bucks. Okay, so that would be a 1,150% return, or you're risking $1 to make $11.50 versus if you did the shares and you went out and you put out a pocket over 178,000, and if you did hit that 1830, okay, wow, you made $48 per share. You made a 2.69% return, but look at that risk, huge. Versus here, you're risking 80 bucks and you could potentially make over 1,000%. So there's just no reason to actually ever trade shares again, period. You can just do all these different types of spreads. Never trade shares again. All right, so here's the other part of this butterfly that's such a great benefit for your trade portfolio is that here it is the morning of expiration. So the expirations was going to be on the September 6th here, and here it was like at, it's about 9:30, about an hour and a half after the market's been open. So you can see it was trading at about 1836. So it went up, and our target was 1830, was actually over that. But here's where that butterfly was at that point in time. You see that wide wing butterfly, see all that black area? That's the profit that's still in the trade. Now in the morning, about an hour after the market opened, it was trading right here at 1836. So the profit though had a nice little profit. So it went from 80 bucks, 80 cents. Now it was up at $230, okay? So that is still not a bad profit. That's $150 per spread right here. Or we'll take it 187% return, nothing to sneeze at. But there's still a lot of potential profit left. So this is like, the first hour after the market opened, but now we've got the rest of the day left. Now here it was at the end of the day. Look at the difference. Now take a snapshot picture, just kind of focus on here. See that big area here? Let me just point this out. That area, that black dark area there, that's all profit in there, okay? And we're trading here. Now look what happens at the end of the day. Look what happens to the spread. Now there's barely any left. There's just that little speck right there. So what's happened here is a big part of the profit of this spread is a selling component. So when you do a butterfly, you've also got an additional spread where you're short time and you're short volatility. Now, at the end of the day, at expiration, time goes to zero. So you capture that full profit, and volatility go to zero, those two components. And that's what you're getting. You're stripping that out, and that's the profit. So now look what happens. So now you went from 80 bucks. Now the spread is blown out to $695, okay? So now you've got a profit here of $614 per spread at the end of the day, the same day. This is on the expiration, but this is towards the end of the day. So you've gone from $180 profit per spread, which was about that 189% return. Now at the end of the day, the same trade, you've got a $614 profit per spread. That's a 769% return versus the morning. Plus, if you were doing Amazon just the shares, whoopee, you made 2.69% return. But look what your option trade made, 769% return on that capital of 80 bucks versus your capital at risk of over $178,000. So it's just such a great spread, so much flexibility. Now here's another really fun thing with the butterfly, and this is what we call the lotto tickets. So these are really selective special trades. They don't pop up all the time, but sometimes you're going to get it in a certain situation, and they're so much fun, and they're just unbelievably the way that they work. Let me just look at the questions real quick. So the question is, when would you break the upper or lower wing to ensure profit if the price goes through your strike? Well, it's all going to depend, what with the butterfly, it all, comes down to a lot of it is kind of timing into your expiration. So we'll go through some examples, but when we do set up a butterfly, what you want to do is you want to have enough, a number of contracts. Maybe you trade, maybe you have 3 legs or 4 legs, okay? So if you do one contract, that's fine, but you're not going to have the flexibility to kind of leg out. Now with the butterfly, let's say you have something like this. You get into it, and you first get into it, the max is going to be right at expiration. That's when everything gets stripped out. So what we'll typically do is you kind of start taking a little bit off. You lock in some profit. Maybe you've got 3 legs, so you've got 1 leg with, let's say you have 1 leg with 2 contracts, or you could have 1 leg with 4 contracts, and then you have your second leg, maybe the same. You have your 3rd leg, or you might do 4 legs, okay? So you get a little profit, you lock it in, boom, you take that leg off, take a little bit more, take that next leg off. Now the last leg we want to try to hold for the last squeeze, into expiration. So we're reducing our risk, but we want to keep a little bit, just to really try to capture the full thing. And so the question was, when do you leg out on the spread? Now, if the market has a lot of really big momentum, let's say you had a butterfly, and let's say your target is right here. We'll say it's $100. Okay. Now, and you're looking at this. You've got, you want to get a target that's got a good, solid maybe upside resistance is right in here, where you don't think it's going to plow through, right? So it could be some heavy moving average resistance. It could be price action, option activity. So let's say that was at $100. That's how we determine the body, okay? So we think that's going to be a huge barrier that the market can't, like a overhead of a bunker, it's not going to be able to go through. So we make that the top. But if, let's say we get a big move and it's, starts chipping away at that, and then it looks like it's going to break, that's when you want to start, either close out your butterfly, or you could break a leg. You could close out the short side, leave the long side on for that break to the upside, right? So it's really something that you have to look, each situation will be different. So you have to really look at your charts, and what you don't want to do is let it just rip through, the upside short strike of your butterfly, just like a credit spread. So if you take credit spreads, kind of think of the same situation. If it starts looking like it's going to penetrate and rip through your short strike of the butterfly spread, then, close it out, or close out one leg that's going to be the negative part of the trade, and stay with the long leg, or the other way around. So it's a little bit different for different situations that you're in. So it really comes down to, you're trading and you're reading the markets and reading the charts, and working accordingly to what you have. Okay, so a little bit, everyone is going to be a little bit different as far as how to manage that kind of risk. But that's a great question. Now here's what we call the butterfly penny trade. So this was one member, Bill, and he really summarized it really great in general for the butterfly. So this is what I really liked what he said. He said, the butterfly strategy is one of my favorites, okay? It's the big winners, right, obviously, that eventually make the difference in any trading account. That's why I was saying earlier, we chip, singles, singles, doubles, doubles, and then occasionally you get that big home run, and that's what Bill's talking about. Eventually, that's what makes the difference. But you want to stay controlled in your trading, so you're in there for the long haul, so you don't blow up your account, right? If you go crazy and you blow up your account, that's it. With trading, you want to stay with the time, and you want to stay with, just chipping away. And then occasionally you're going to get the big winners, but be patient and have a game plan, and be patient and stick with it. Now, with the so-called low risk option strategies that are being sold to the public, an account without the potential to hit that big one once in a while not betting the ranch is a slow ride up a long hill. That is so true, right? But this strategy is easy as ABC. So that's pretty cool too. A, B, C, like a butterfly. And so I really appreciate what Bill said, and it's so true. And so here's a really great couple examples of what he was talking about. So these are very selective. Once in a while, we'll see this kind of setup that we want to jump on, and we'll take it, and they're unbelievable. So here's one that we did, and these were alert trades. These were sent out to my members. So this was on a butterfly using SPY for a downside move, and this was a penny trade that we were going to do with SPY. Now, penny trade is what we call where it goes out at the strike at expiration that you're targeting. So with this trade, we were, it was trading at 573.80 when we set up, and our target was going to be down to this area here, the 560 area. This was a bit based on option activity, price action support, looking back at big support areas. And so our target was going to be this 560 area. So it's trading at 573 right here. You can see this was a 200-day moving average. See that? So you can see it's right there. It's chipping towards that 200-day moving average break. Now, somebody just asked about when do you break a leg? Well, let's say you had a butterfly here that was targeted, that was set up here at this 273. Well, you could see it's chipping away at that 200-day. So you would want to make sure to close out that short leg if you had it on, just leave your long leg on or adjust your butterfly down lower. That's what we could do as well. Okay, so here it was. We had a cycle reversal. We had negative momentum 1 and 2. Again, these are my indicators that you can add to your cart. And so then we were targeting down here, this area here. All right, so we set up a butterfly and we did this super low risk, as you're going to see. All right, so here was the trade, and again, this was an alert trade that was sent out to the members. So this was, on the 6th, it was trading at 573.80, and so we set up the butterfly targeting 560 was our target. So we did the 565 put long, short the 560, short the 560, long the 555. So we had a $5 wide, right? 65.60, so $5, that's $500 per option contract. So $5 wide put butterfly targeting that downside area of 560 based on Fibonacci price support, except some other things. So set this trade up for 39 cents risk, 39 bucks, that's it. Now the profit would be your spread width of 500 less your cost, 39 bucks, that's your cost right here, you can see it right there. Your potential profits 461, your cost is your maximum risk here of 39. So if you're wrong, you lose 39 bucks. That's what we call a lotto trade. So if you're willing to, expose your profit potential loss to 39 bucks, which most people can handle that, then that's kind of like, okay, let's do what we call kind of flip the coin, a binary trade. So we're going to either win or lose. Now, if we wanted to, we could close it out for a smaller profit, but typically we'll just say, okay, let's risk whatever the risk is, which is typically going to be $39 or less, and then go for it. Okay, so in this situation, that was the risk, 39, but the potential profit would be $461. If that was hit, you're going to make 1,183% return, or something in between, which is still a fantastic return. And if you're wrong, you lose 39 bucks. Okay, so that's what we call it, a lotto trade. And these are not trades we do all the time. These are very selective. So here it was going out, to the penny almost. It was at 560.32. So you can see there was no black area. Look at that, barely a speck left. So this went from 39 bucks. Now it was trading to 456 on the spread. So this was up $417 on that risk of 39. That's a 1,069% return over a 4-day period. All right, and again, we're not holding the whole thing for that very last second. You're going to take a little profit, leg out, but we want to keep a little bit for that last day to see if we can capture that, that perfect pin. All right, so that's a really great example of one we did there. Now here's another one that always, this one is always, I get a smile with this one. This is the one that we did on Tesla, okay? And this was for an upside move. So in this trade, we had Tesla was trading at 189.35, and we were gonna target a really big area that was $200, okay? So that was gonna be a lot of things we were looking at. We were looking at a 50% retracement area for Fibonacci. We had a big moving average there. We had see that dash line there. That's a prior week's high. So there's a lot of stuff there that looked like a big kind of overhead ceiling that it couldn't get through. So that was our target. Okay, so we sent this trade out. I sent this trade out, and this was on the 8th, okay? And so then expiration was 2 weeks later on the 16th. So this thing, let's take a look. So set this up targeting that 200 strike. So with this one, went out, we bought, it was trading at 189. And so targeting 200. So we bought the 197.5 call, sold the 200, sold the 200 again, bought the 202.5. Now we did this as a butterfly, or you can leg in, leg out, but we did this, just put it on as a butterfly and just sit. All right, so you can see it's a $2.50 wide spread, right? So we've got a $2.50 wide spread, so that'd be 250 bucks. Look at the cost of this trade though, 12 cents, 12 bucks, that was it, boom. That was the cost of the trade. Now we had a $12 at risk, okay? Now, if it hit the top of the tent, we could make $238 on that risk of 12. That's a 1,983% return, almost 2,000% return. Okay, so you can see your risk here, 12 bucks, cost of the trade, potential profit, 238, and or anywhere in between. So that is totally a lotto trade, right? You flip a coin, boom, binary, 12 bucks you win, 12 bucks you lose, 12 bucks you lose, $238 you win potentially, right? So that's where it went, just the perfect pin on this trade. So this trade went out exactly to the penny at $200, just unbelievable trade on that. So it went from 12 bucks to 250 bucks on that spread. That's your spread profit of $238 per spread, 1,983% return. So if you did one, 238. If you did 10, 2,038. Again, we're legging out, but you leave some for that very last go around. So that is your pinning trade, which was perfection on that one. And you don't get those all the time, but that sure was fun. Let me just check back here. So yeah, so what John is saying here's and we'll look at this. This is what we call a broken wing butterfly. We'll look at this in just a minute. So this is what we call a broken wing butterfly or skip strike butterfly. So this is one variation that you can do. I'm just trying to copy and paste this in so everybody here can see your question. Yeah, so I'll show you an example here of this exact setup that you're talking about. All right, so that's a really great look there. Now, this is a really fun, cool one. This is what I put this together, what I termed and I called Batman butterfly. And this is one that we had on Apple, all right? So it looks like Batman's, mask or whatever he wears, right? So this is a really cool setup. So this is one that we had set up. This was for Apple. And so, at this one, we didn't know if it was gonna go. This was set to target $200 to the downside or $210 to the upside. So we were looking at a lot of different things, but we were seeing a lot of potential that the 210 strike could be a big target, or the other side of the trade was that the 200 strike could be a big target, but we weren't sure if this thing was going to go up or down when we're setting the trade up. So this was set up like on the 10th when it was trading at 202. So at that time, it's trading at 202.70. And so we're looking at, the charts, all the different things that I look at to analyze. And it was looking like it could go out for a pin at 200, but there was a potential if everything started moving that if the thing turned around, it could go out at 210. So wanted to set this thing up. We were so far out, at the 10th that wanted to go ahead and set it up for either target because we could do this super cheap with what I call the Batman butterfly. So that's what we did. So here's the profile, what this one looked like. So we set a target for the upside move. We were setting potential that it could go to 210. We were targeting 210, but we didn't know for sure. So we did another butterfly part combined with this where we were going to target 200. So we had one targeted at 200, one targeted at 210. So here was a call butterfly to 210 and a put butterfly to 200. So we had that. We had the 207.5, 210, 210 to 12.5 call butterfly. This cost us basically 20 bucks, right? Super cheap. But then we added to it, we didn't know, we added the downside target. We did the 202.5, 200, 200 to 197.5. That cost us 25 bucks. So we had a total cost on this Batman butterfly, the two butterflies together cost us 45 bucks. And this went out right here. So it went out, going out here at 200.09. So almost perfect to that pin. So this was the spread blue to what was at spread width was at 205. So, here it was at $205 here, the spread blew to, our cost was 45. So the profit was the difference of 160 bucks per spread. That's a 355% return. So that's an example of the Batman butterfly when you're unsure. That's one way you can incorporate using a butterfly. Now here's one that John was just kind of referring to. This is what we call the broken wing, or sometimes you might hear it called the skip strike butterfly. And the butterfly broken wing is very useful to speculate, on something, a stock, security, whatever, that's kind of been, stagnant to either slightly bullish or it could be bearish, depending on, your kind of bias to the market, what you're looking at. But let's say you're confident that if it breaks out, it's going to, go to only a certain direction. So if you're very confident on a directional move, either maybe to the upside or maybe to the downside, you can then set up a trade that we call the broken wing or skip strike butterfly to lower your cost, okay, of the trade, but give you a big potential payoff, but really lowering your cost to very, very little by skipping strikes, okay? And so this is simply a butterfly spread where the risk is then inclined to one side. So either you're bullish, then we can structure it to reduce our risk to the downside, but keep us, potential big upside return, or if you're bearish, reduce the risk to the downside, etc. So the main purpose then is to adjust your risk profile of the regular butterfly to reduce the trade costs and give yourself a bigger return on that lower cost. So this is one that we had done on Microsoft. And so this was where Microsoft in this example was trading at $309.45. We were bullish, but and we didn't think it was going to go much higher. There was a big, area here, kind of resistance area that we're looking at 315. Okay, so it was trading at 309. We set this broken wing butterfly up, and then on the 17th, it was trading right here at 313 or 314 in that area. So this was one where we're bullish. We didn't think it was going to break to the upside, so we were able to strike the butterfly here, reduce our cost. And we were bullish on the upside, reduced our cost, and then had a lower cost trade. So you can see here was our price target. We were looking for that 315 target, and we were pretty confident. It was pretty confident that was a solid top target zone, that it probably was not going to get able to break through at this expiration. So we did the skip strike. So we went out and bought the 310 call, sold the 315 against it. So that's a $5 wide spread. See that? And then the other part of the trade was we set the 315 call short, but we widened out the other side of the spread to 322.5. So you can see that's a $7.50 wide spread. Okay, so we had a broken wing butterfly here. Now by doing that, we reduce our cost of the trade in this example to $85. Okay, so we had the skip strike on. We had then the potential, if we hit our profit target at expiration, to make $415 on that reduced risk of 85 or 85 cents per spread, or 85 bucks. So the spread width here was 500 on the debit spread side, less our cost 85. So potential to make 85 bucks, or $415 per spread on 85 bucks. That would be a 488% return. Risk $1 to make 488, but actually the potential risk though, since we did a skip strike, was that increases our potential loss. Here you can see was to 335. So there's no free lunch, but that's what I was saying. If you have an area where you think you're really confident it's not going to break through, in this example, we thought 315 was solid, wasn't going to break through. So we were willing to risk having that, for the lower cost. But if you're wrong, in this example, you would have lost 335 if it, just kept going up, something like that. All right, so that's the difference there. So let's take a look at what this looked like going out. So here's what the skip strike or broken wing butterfly looks like. You can see the spread here. Okay, so we've got here's the 310 right here. We're long this call here, the 310. short the 315. Okay, so there's your $5 wide spread there, but then we're short that 315 here, but we widen the spread out over here to make less cost. So the further out of the money, the less it costs to buy it, right? So that's the difference. You can see if we did a balance, it would look like right there, but we skipped a strike further out, reduced our cost to 85 bucks, and we had this going out right here, had a pretty decent profit. So it went from, we had the spread now was at 222, less our cost of 85. So we were up 137 bucks right here, still had a bunch of potential profit in there, but that's 161% return. All right, so that was a pretty, that's a very selective trade for certain situations, and that's a pretty cool way to do it. So this was, a couple members, Gene, made 143%, and things like that. So these are for certain situations, but that's your broken wing. Now here's an example of your unbalanced or the ratio butterfly. So this is another variation of your regular balanced butterfly, but this one alters the risk too into one direction, but also that increases your potential return. Now this one is called a ratio because you add another credit spread to it. So you've got a ratio of 1 to 2 kind of ratio on this trade. So it's a ratio, but it's a selective trade. It's not one you're going to do all the time. So the balanced butterfly is the one that you kind of do over and over and over, but these are for such certain, kind of selective situations. So this is one that had set up. This was a ratio butterfly on Tesla. And so it was on the 12th of May, it was trading at 168.50. This was, out the 19th, it was trading at 180. What do you do? What do you think of a broken wing butterfly that lies below the stock price with a small credit if the stock goes up, if the stock goes down? Well, that's the other thing with a ratio butterfly. The times I like to use a ratio butterfly is just kind of as a credit spread. If you don't think it's going to get there, you just keep their credit. So that's where I like to use a ratio butterfly, and that's what we did in this situation. We had a big target here at this 180 strike. And then we set this up so that we're going to either get a credit if it came back off, or if it did pin there, that's your big bonus. All right, so this is a ratio butterfly. So here's what this looks like. So this was then going out, and we bought, the target was 180. Okay, so we bought the 175 call, sold the 180, so $5 wide. And then we sold the 180, bought the 185. But look here, we did this again. So then we again sold the 180, bought the 185. So it's a 1 by 3 by 2. Okay, see, that's what the ratio is. All right, so we had this ratio butterfly where we had that additional credit spread on the trade of the 180, 185. That's an additional credit spread. By doing this, we were able to, this didn't cost us anything. We were able to get a credit of $10. Okay. So what I like about this is that if you have a situation where you think, I don't think it's going to get to 180, but I can get 10 bucks. And if it doesn't get to 180, boom, I've still made 10 bucks. But maybe if it does get there, man, I get a big, huge bonus payoff. So in this example, you can see that, okay, if it doesn't get there, I keep my 10 bucks. But if I do get there, potentially, I've got a potential to make $510 on that spread. Now, again, there's no free lunch. And if you're wrong, and the ratio butterfly in this situation, the price could rip straight up, you could lose 490. All right, so these are selective for certain situations, but that is what we call the ratio butterfly. All right, and for certain situations, it's a good way to go. But what I wanted to do today is just kind of show you some of the variations, and then you get an idea of the ones that you may want to do. So here it was going out, boom, right there. So this one worked out really well. So it was going out right there at 180.07, and that was pretty close to a pin. So this was up, went from $10 credit to 483 debit. So up $393 per spread. And again, you're legging out of these things, but that's what this ratio butterfly looks like, what it does, and what its purpose is. Now the next thing we're going to do is get into the long call or put Condors. So these are Condors, and these are not iron Condors, these are long Condors, so totally different animal. And so what these do, this is going to give you that wider profit zone. You can see here, bigger, wider profit zone, not like a really having to thread that needle like a butterfly. Very structured for defined risk and great for hedging. Directional swing trades, wide profit zone, great for high volatility markets because we can really, keep our risk down. We take advantage of the implied volatility with this, selling. 1 to 3 weeks out, no time decay. Your typical returns on these are 1.5, 2 to 1, 4 to 1, something like that. Okay, so we do a lot of these long condors, either puts or calls to the upside or downside. Here's one that we did not too long ago. This was on Palantir, and here was a long call condor spread. And again, you can leg into these, leg out, or just put them all at once. So here's one that we did. This was alert trade again that with Palantir. So we set this up on the 13th. It was trade at 123, and then here it was going out on the 16th. It was up, at 128.88. So we set this trade up right in here, and we got it off right there. So pretty much target where we were looking for and targeted out to that target. And here's the trade setup that we did. So with this, again, we get that wider zone of profit. So this is one we do a lot, and these are very low cost trades that we can do. So we set this up along the 125 short the 127 call debit spread, and then shorted against the 136, 138 credit spread. So we had this structure here. Again, we could have legged in. In the trade, sometimes we'll just do that, leg in, and then add the credit spread side after it shoots up, something like that. But here we go. We had this a $2 wide spread, $200. Cost of our trade was 72 cents, 72 bucks. So potential, see that zone there's anywhere in between there, between the two spreads, we make 128 per spread, 177% return, nothing to sneeze at, okay? So we're just chipping away. These are trades that we do a lot of these. Okay, we did a couple of these last week. I'll show you, I think I've got those set up to show you a little bit later. So this was one of those that we did, not too long ago. So here we go. This one went out just pretty much right where we wanted it to, right between the two spreads. This was kind of like the bullseye area right here, the spread zone right there. So it went out there where we needed it to. So from 72 up to 200 bucks. So this was up that 128 bucks per spread. And that's a look there at the call condor. We can also do it for a downside moves using puts is what we can do. And that's it. So here's one that we did for a downside move. This was on SPY. And this one we actually legged into. So this was a really good one where we really nailed it. And so SPY was trading here at 568, right where my pointer is right here. Okay, and we were looking for this big breakdown. It was trading right here at 568, right below it. It closed below that 200-day moving average. So we were looking at this. We jumped into this first with a put debit spread, and then we adjusted it, and now we have this put condor on, and now it ripped down to 556. So it went from 568 to 556 really fast, and we set up this put condor and took advantage of it. So what we had here was we had long the 563 long, 560 put short. Okay, so we had this kind of put debit spread, and then we sold the 550 long, the 554 bull put credit spread here. So we had this trade set up for a total cost of 43 bucks or 43 bucks per spread. Okay, the spread width here, you can see $3 wide spread on both sides. So $300 less our cost of the trade. Right there, 43 is a cost. Potential profit in here of 257. So that's a 597% return on a, if it goes out between the spreads there at expiration. So potential really big upside on this, but big wide profit zone as well. And so this one actually did go out, right between in the kind of what I call the sweet spot. So this went out between the two spreads. So you had that long put debit spread here. You had your other part of the spread here, the put side, credit spread goes out right here, max profit from 43 up, spread blew up to 300. So here's your, $257 per spread profit. There's your 597% return on that risk of $43. Okay, so that's a debit spread Condor. Now this is what I call, one of my members kind of coined this and said this is really great stuff for what he referred to as opportunistic hedge trading management. And this is a really good example of that, of one that we had on QQQ. So this was where we originally had a long put debit spread, but then we were able to adjust it to a free trade. And so this is that kind of, opportunistic hedge trading management. And so QQQ was trading here at, what happened there? Sorry about that. Let me get this right here. One second. So QQQ is trading right here at 365, okay, on the 28th. And then what we did here, we set up, the original trade was trading right here. It was breaking down. And so let me just kind of get this where, right here at 365, right there. So we went long a put debit spread, okay? And then we adjusted it. So this is on the 28th. So first part of the trade was a put debit spread, which I'll show you in a second. And then when it ripped down right here, after it broke right here, and it went down, it ripped down, we sold a bull put credit spread and captured back the full premium of the debit spread and actually ended up with a credit. So adjusted it on the first, and it was trading down here at 354.53, and then we had our profit when it closed down at 359. So this is a really good example of how you can hedge and take advantage and turn things into what I call the free trade. And so here's the kind of the first trade. Part of the trade was trade one. We originally set up a put debit spread the 6th October, 364, 360 put debit spread. This cost $121 on that spread, okay? So that was our spread risk, pretty decent positive risk ratio. So we had a $4 wide spread, cost of the trade 121. So the potential on this, if we expired, to the downside below that short strike of the put, 560, we make 279, 230% return, not bad. Now, what typically has been happening in these markets, we might get a big rip down, but what happens, they tend to pop back up. So when they rip down, what we were doing is then we would set the other side of the spread in case it ripped back up, and we still had a potential for a big, huge profit, but on reduced risk. And this one actually reduced our risk to zero. So then when it really knocked down hard, in this case, it traded down and it traded to trade two, it was trading at 354.53. We set up the other side of the trade. So what we did here was we sold the 354 put, bought the 350, and we brought in a credit of $141. Okay, so then you can see here what happened. We adjusted to a free trade, actually a credit. So trade one, we had the put debit spread, the 364, 360. We paid 121 bucks, right? And then when it ripped down, we sold the bull put credit spread here, brought in 141. So actually then we ended up with a $20 credit, okay? So now if it went straight back up or straight back down, we would still make 20 bucks. But if we went out, between our two spreads, the sweet spot in this trade, we'd make $420 on zero risk. And that's what happened, went out right there. So this went from, 121 bucks, and now we had that max profit of $420 there. So that's the beauty of this. So you can see the 121 went from 121 to 400. The credit spread side, we brought in 141 bucks, that expired worthless. And so there was our profit, so we had that profit, of 152 plus the 20 credit and, 420 bucks total profit on zero risk. So there's just so much you can do, once you understand how to use these trades, these verticals, and I call it mixing and matching. And that's, what we're going to get into next weekend, just all the nitty gritty of all the different variations. Great question. So here's from Craig. With September, October typically being bearish, would you suggest out of the money put butterflies? That'd be a great strategy. Yeah, if you wanted to do, if you wanted to get set up for some kind of low risk hedging, that would be a really great way to set up some different, low risk, low cost butterflies targeting certain big areas to the downside, because, potential seasonality weakness. Okay, that's a really good idea. All right, but now next weekend we're going to get into the nitty gritty of this, and we're going to go through every variation, all the different ones I showed you earlier: the broken wing, the skip strike, broken wing. I mean, it's like I call it bubble gum, and the shrimp, right? We're going to go through every variation with examples to show you, so then you can get an idea of when to use the different variations or not to use, and the ones you feel comfortable with using, and then you're going to be, set to go. So here was this one going out. We had this one set up to where we brought in, now we had zero risk. We had that credit, and boom, we had a credit here, potential to make 420, and this one actually worked out perfect. Okay, so that's just kind of wanted to show you all that. Now, again, if you'd like to master these high reward, low risk strategies that work in any market environment, then make sure to use that link I just gave you. We'll go back through this. Any questions? So go ahead and use that special link, powercycletrading.com/special. Plug that in, and then use the lowercase or lower cap OB butterfly, excuse me, BF 15 into the promotion code when you pull it up, and you'll get a 50% discount off either course package 1 or 2. So this will be next weekend, starting the 6th, 11 a.m. Eastern to 2, or however long we need to go to get covered to finish covering what we're going to do in that part of the course, part 1. And then we'll finish up on Monday, the 9th, come in at 4 p.m. Eastern to 5, or however long we need to finish, what we're going to go through. So here's everything you'll get. Again, we'll go through this and take questions. I'll show you a bunch of examples of the recent alert trades that we've done. So you can see the earning trades, setups, and butterflies, and condors, and calendars, and all that stuff. But if you sign up now, this should be summer. I don't know how that got in there. So this is your summer bonus. You'll get 2 months to my trading club. Okay. And so, the total value of this is $1,600. Okay. So, and the course price is $197 when I go out next week to my list of clients. But if you sign up today, you'll get that 15% off. So you'll get this course for $167, and with the course comes my Fibonacci price target mapping that we're going to use to set profit targets for the butterflies. If you look to my website, that costs $297. You're going to get that for a bonus of zero cost. You're going to get my start trading options here, that course for $197. You're going to get membership to my trading club for 60 days, a trial membership. So it's $97 a month, but you're going to get 2 months for no cost, okay, part of the package. And then we'll do the follow-up Q&A. You're going to get that the next day. That's my cost of that, doing that. My option tutorial, which goes through the option Greeks, $97. My option trading manifesto shows you how to do other ladder trades and ratio spreads, stuff like that you probably had no idea about. And so all that good, really additional bonuses for $1,100, full course package over $2,700 for $167 today. So make sure to use that promo code. And if you go here, you can see the cost of these bonuses. You can see where the costs are. So if you go here, you'll see my Fibonacci price target mapping, or any of my other courses. You can see my start trading options today. This is, you're going to get this as a course bonus right there. You're going to get my Fibonacci price target mapping course here. These are all my different courses that you can go through and look at. And then you're going to get that target mapping course here. So you can see everything on my website if you want to go check it out. So that's all those bonuses, a really great package. So put that in. And then if you want to add this to with the alert service, you're going to get the alerts for the next 4 months. That should be summer. And then you're going to get the trading club for an additional 5 months. Okay. And then everything in course package 1. So with this, you're going to get my different, I have 5 different types of alerts I sent out. So it'd be either butterfly long condors, calendar or calendar diagonals, could be a monthly butterfly pinning trade, or it could be a breakout trade, which could be a credit spread or debit, or it could be a selective earnings trade. Okay, so there are 5 different types of trades that I send out with the alerts. And so those are all the ones that would be covered with the alert service package. And you'll have that for the next 4 months. And you can stop and start the service whenever you want, right? So if you're going on vacation, you can stop, start, come back in. You can do that yourself manually. And then the trading club for 5 months. So everything here today, you use that promo code. It's going to be 507, and there is a 2-pay that you can use. Okay, so selective butterflies, condors, or could be calendar diagonals, selective pinning trades, breakouts with credit spreads, and options for earnings trades. So when I do send out a trade, I'll give you the exact trading guide for each alert. I use a service called Telegram. It's free, and it's really, really fast. So it's a great service. And when I send it out, a lot of the members just do their own thing. They just want the trades that I select, and then they'll either buy calls or puts or whatever. But when I send out a trade, I always give you the option, spread that you can use. And then with that, I give you everything you'll need. And then I monitor those trades all through the trade duration until it ends. Okay, so then I do a setup video review of the trades every day. I do a market video review every day. Trades are listed and archived. We do a weekly Q&A that's live and recorded. You'll have that then for the next 5 months. You'll have access to my virtual trading room for the next 5 months. You'll have access to my virtual trading newsletter every day after the close, 5 months. And you'll have 50% discounts on all courses and trading software for the next 5 months. So a lot of stuff there in that course package. If you want to do that, I don't know how that came back in. And so just kind of a review there. And then here's just kind of an updated review here just to go through, and we'll look at some of the alert trades so you can get an idea there. But started the first alert service in May of 2018, and through yesterday, again, we've had 922 trades closed out. Of those, 663 winning. I'm really shooting for high winning probability trades based on our indicators, scanners, everything I look at. I put a lot of time into selecting these trades, and you can see I've been doing it for quite a while. All right, and that's then even taking into account all the other years of my trading. And so 67 break even, 192 losers. So still averaging around 79% win rate. Again, these are unaudited, kind of a summary, but we've been really maintaining a really high win rate is what I'm try to achieve. So that's an overview there. And again, use that link that I just gave you, powercycletrading.com/special. Okay, and then BF15, and take advantage of it here today, BF15, and you'll get everything. This is one of my premier courses I do twice a year. So make sure to take advantage of it if you like, and you'll get it for $167 with all those bonuses, or if you want the alerts, $507, which will be one great investment for your trading. Okay, and again, check out, see if you've had it in the past, no problems there. Now, here's kind of a review of the outline of the course. So part 1, I like to start out with really the Greeks that are vital, so you kind of understand the fundamentals of how the butterfly and long condor, the options actually work and affect the price when you're trading the butterfly and long condor. So we're going to go through the Greeks that are important there, things like the theta decay, how that impacts these two spreads, the impact that the volatility has on these two spreads, which we call volatility crush, and then how the option pricing works, so you can see how the price is the value of the option is for the butterfly and long condor and the different variations of time. All right, so how that affects the spread. And then we're gonna, we'll do a kind of an overview brief of using Fibonacci price target mapping and standard deviation for setting our targets for the butterfly. So if we're setting a body of the butterfly up or down or condor, this is how we do it with the target mapping and what we call standard deviation, expected implied move type calculations. So we spent some time on that. So, I go through the steps that I use for every trade that I put on so you can understand and use it yourself. And then part two, we go through every variation so you can see with real examples of, the variations of how, why, and when would you use just a long call or put butterfly, or maybe, the wide wing butterfly or narrow wing butterfly, or how and why to use that broken wing butterfly, the skip strike, or the ratio butterfly, or even a broken wing ratio butterfly, the iron butterfly that I didn't get to cover here today, that lotto butterfly, vacation butterfly, and long condor, plus all the different hedging defenses that we will do using butterflies and condors. That'll be the next part of the course. Okay, so then, what are the best time frames? Do you go out 1 day, 2 weeks, 3 months, 10, or a year, whatever? What stocks, ETFs, how to profit from that volatility collapse and that theta decay with the butterfly. How do you get those trades that give you the 10 to 1 or 20 to 1? How do you find them? How do you select them? How do you go about that? And then, get into these monthly option pinning trade strategies using butterfly. These are really a lot of fun. Now, these will pop up every, you have monthly expiration, 12 times a year. So these are a great way to really get your equity curve popping up if you get the right selected butterfly in these kind of pinning trades. So we go through that in the course, and then how to set up your pins. How do you select the trades, for these, using unusual option activity is a big part of what I use for these kind of targeted trades. So go through that. And then the next part, we get into the long condor, okay? So how that works. So the long condor spread, the capital at risk, how that works, positive theta, how we set that up, how, why, and when to use this option spread, the long condor, not to be, confused with the iron condor, totally different one. And we'll go over the two different ones to show you how this one is different, a huge difference. And go through how to use that in your directional trading. We use those a lot, like I said. And then part three is kind of the hedging component. We go through what I call the progression of hedging. We can, we can start out with shares and how to hedge that out. So kind of the progression of hedging. And then we go through the butterfly long condor hedge to use on a core position. And then how to use the butterfly defense for your vertical debit spreads or your vertical credit spreads for that defense. So somebody was asking for a credit spread, like if you get, a credit spread, a short strike being penetrated or looks like it's going to get penetrated, we can adjust this to a butterfly. I'll show you in the course how you can do that as a defensive strategy, or defend a vertical debit spread, and adjusting that to the condor or butterfly. So really big, important part of the course here for hedging. And then, step-by-step checklist, again, of how to use and when to use. So it's kind of like a blueprint of these trades. Go through, execution adjustments. And then in the resource, we'll also touch in the course assignment risk, expiration risk, how to judge that and work around that auto exercise. So you're not, some people are freaked out thinking they're going to get exercise, but in the course, I'll teach you how to go about assessing that potential, okay? So a lot in this course that's covered, and it's all dedicated to these two spreads. And then you get a nice big trading library, because one of the best ways to learn, in my opinion, is, through looking back at past trades, either your winners or losers, to see what you did right and wrong, or, on a trade. And that's where you can really learn, okay? This was from, one of my members, Richard, shared this with me. He said, Larry, you are the only one that I know of that provides competent, realistic instruction on how to have that Houdini escape hatch plan to utilize when various types of option trades go against you. So that's part of what we're going to cover in the course, how to do this. So this allows a trader to then calmly use their head to make an appropriate trade adjustment instead of wildly panicking and having their head handed to them. I greatly appreciate you sharing your hard-earned profitable trading knowledge and techniques, Richard. So that was really nice of him to share that. So let's go through the bonus package and then take more questions, and I'll show you some more trade examples and go from there. Okay, so first off, again, you're going to get as part of the bonus for the course, and this is what we're going to use to set profit targets for these butterflies and condors. We're going to go through the price target mapping, and you're going to get this as a bonus. Okay, so this is an on-demand course that I did that covers all what I call price target mapping, and this is based on a process I use of not only Fibonacci, but gets into alignment of moving averages, along with price action support resistance, standard deviation price target forecasting as part of this, and then unusual option activity. So it's a really great course that goes over this combination to do what I call price target mapping, where we can set our big profit targets or defense targets using this type of analysis. Okay, so it's a 3+ hour course, 139 pages. This on my website. If you wanted to buy it there, would be I think it's $297. You're going to get this with the course as a bonus today. All right. And then you're going to get my start trading options. So this is a kind of intermediate option beginners course. This will take you through if you're just starting out. It's a great one to kind of review the inside tips of, trading options before you start, option basics, mastering puts or calls, how they work, how option expiration works. And then the course also covers 3 different strategies. So it goes through and shows you how to use a cover call, how to use a cover call with the protected put, a collar, and then how to use the vertical debit spread. So it's a really great course. You'll get this as a course bonus. It's yours. All this is yours forever. Okay, so really good to add to your trading library. And then you're going to get 2 60 days to my trading club. So this is a really great bonus. So you have access to my virtual trading room for the next 60 days. You can start this whenever you want. And so my trading room is open from 9:30 to 10:30 Eastern every day, Monday through Friday. And then I do a video newsletter every day after the close. You'll have access to that for the next 60 days. Member to my trading archive, see the trades that were set up, live Q&As every week and recorded, Traders Educational Vault, and 60%, 50% off discounts on all courses and software. Now, this is one thing I always like to put out and point out is that Jay, one of my members, who's really been a long-time member now, he says reading books is fine, but seeing the actual option trade setup makes a huge difference. So that's really something I focus on with the trading room. When we do a trade, I'll show the option trade and tell you and show you why that I'm using it, how it's used, and what we're doing with it, all the different ins and outs of it. So you'll learn a whole lot just being in the trading room. And so then you're going to get, the follow-up support Q&A, and then again, that 60-day trial membership. So a lot of support after the course. Then my option trading tutorial. This is just another option course for you. It's a 60-page option guide with videos. And this course covers just the Greeks, the delta, gamma, theta, option pricing, how that works, standard deviation, option delta, and trade probability. So just another really nice little option course for your option library. And that's what I really focus on. And then the last thing, my top 15 option strategy guides. So this is pretty cool. You can go in here and then just get a quick review. Okay, what is that ratio spread? What's a ladder spread? What's a straddle or strangle? What's a diagonal spread? What's a back ratio spread here? Just so these are all in here. Trade construction and win. So just another really good thing to have to your library, so you can understand all the different things that are out there and available to you. Why would you use it or why not? So it gives you that information. And then last but not least, I like to go through a few of these alert trades to show you what you'll get if you do want to sign up for my alert service as part of the course package. And this was really nice from Waleed. He's one of my members from Kuwait, and he said, Larry, I have to mention one thing. I've subscribed to a lot of services when who send out trade alerts. Some are good, others are not that great. But one thing that I'd like that people on this webinar to know is when I get a trade alert from Larry, I do it blindly as time has shown me. He's been dead accurate in his recommendations. So, appreciate that, Waleed. And, I'm trying to maintain those high winning rate trades, and we've done that successfully so far. And then here was another one from Dan. He said, you're very diligent and totally thorough with all your analysis. That is the foundation of success of your alerts. I paid for my subscription with my first 4 trades I took when I was learning just how to trade options. Please feel free to share. And that's another thing. When I go through these trades, I describe and show you exactly why, I'm doing it. And then the follow-up Q&As and stuff, we go, through in addition. So I use this service Telegram, send these trades out. I'll show you a few of these trades here in a minute, but these are really, these alerts go out really fast. As soon as I hit the button, boom, they're out, and they hit your text or your email service, right? So these are Telegram is what I use. And again, it's also a free service. You don't have to pay anything for it, but it's, where you just see the exact details of the trade. All right, so that's what's sent out. Now, when I do send the trade out, I will always give you a suggested option trade. And again, some members just want to do their own thing. So like last week, we did what did we do? A trade on DraftKings, a long trade. Some members just maybe went calls, long calls or the shares, whatever. But I will always give you the option trade that I think would be good based on the market we're trading, the chart patterns, everything. I give you the entry level. I give you the profit targets. That's based on my option activity, my target trading, Fibonacci target mapping, which you're going to learn from the course. I give you what option series to use, what stop loss levels, guidelines we're going to follow. And then I monitor the trades from start to finish with using Telegram, the alert service. So if there's something that maybe takes some profit, maybe adjust, I'm constantly in there watching these trades throughout the day. And then the trades, then after they're done, they're listed in archives, so you can go back and look at them. So all that is in there. Then I do a trade setup video review the day after the market closes on the trades. You get my video newsletter every day after the close. We do a weekly Q&A that's live and recorded. Access to virtual trading room, which is open 9:30 to 10:30. And my course discounts, they used to be 60, I've lowered them down to 50. So 50% off discounts on anything on my website, all courses and trading software, plus a really nice trade and educational vault for all members. So a lot of really great stuff that you're going to get, today if you sign up. And let's go through a few trades that we've done here recently. These are all alert service trades, and these are the butterfly long condors segment or alerts that I sent out. So I started this part of the service back in May of 2019, and through yesterday we've had 235 trades closed out, 169 trades winners, 19 break even, 47 losers, running a really nice 80% win rate. Now these, on average, the average losses are very low, maybe $50, $75 per spread, but the potential returns are potentially big, 2 to 1 up to 20, 25 to 1 potentially. And so these are these trades. Here are a few that we've done just recently, just to kind of give you a taste of what you will get. This is one that we just did not too long ago. This was on DraftKings. Now this one was originally set up and started as a calendar diagonal, but then we adjusted it to a broken wing long call condor, okay? So there were a lot of little adjustment steps. I won't go through all of them, but they're here. I've got it all listed for you, just kind of see the chronological order of it. So this trade, we set this up on the 20th of August. DraftKings was trading at 45.58, and we closed it out yesterday. It was trading at 48, went out right at our target. So like I said, the original trade was we established this as a calendar diagonal, which is right here. So it's kind of small. I won't go through the detail. And then we made an adjustment to a butterfly. We adjusted originally to a butterfly. And then what was happening was starting, somebody asked what happens if it goes up to your, short strike of the butterfly. In this situation, we thought it was going to go through the butterfly where we had established it. So we adjusted this and adjusted this into a condor, okay? So here's just kind of the going through the details of when I send this out, how to adjust. So here it says, DraftKings long trading at 47.70. If long, the adjusted call butterfly, which was the original adjustment, and then I show what that was. So that was long the 29 August 46 call, short the 29.48 call, and then short again the 29 August 48, and long the 29 August 50. So that's a call butterfly. I sent out this alert adjustment on the 26th to adjust. So buy to close the 29 August 48.50 call spread, adjusted trade, and then that we ended up being long the 46.48 call debit spread, and then on a move higher, I said we're going to look to adjust to a call condor. So then it did move higher, and the next day we adjusted this into a condor by selling right here. I said to adjust by selling the 49.5 52 call credit spread, and that adjusted us into this broken wing call condor, which I'll show you next. So there was a lot of little steps to it, but that's what you're going to get. When I send these out, there's a lot of stuff that we might be doing to trade around a trade. So here's what the charts were looking like going into the trade. We had DraftKings trading right here starting to break out. We had good momentum, stock reversal, positive momentum. We did that one adjustment here to the butterfly, then we did the next adjustment here to the condor, and then we had profit. Yesterday it went out pretty close to where we wanted, almost perfect pin on that. So here was the original trade, what it looked like. This was doing what we call a call diagonal. So we bought the 29 August 46 call, was the original initiation of the trade, that sold against the 22 August 48, did those adjustments. So this was originally set up at 92 bucks. And you can see here on the 22nd, this was trading. We had a profit here of about $61 per spread. And then we did some adjustments, but to show you that was the original trade. And then we ended up with this adjustment into this broken wing long call condor. So this is what we ended up adjusting to. And this was then, we were long the 46 call, short the 48 call debit spread, so $2 wide. And then when it ran up, we added to it the 49.5 52 call credit spread, $2.50 wide. So we had this adjusted condor, so spread width $200, cost of the trade adjusted to 36, potential to make 164. That'd be a 455% return on that trade. And here shows you the details down below of that trade. What we're looking at, cost 36, potential to make 164. So that was the broken wing call condor, and this is what it looked like yesterday going out. Went out right here, almost, well, 48 bucks, man. That was kind of our target. So that's part of the thing that I do. I'm trying to really be selective with the trades, and this one worked out really well. So the spread went from 36, the adjusted price there, okay, after setting that up, the adjustments we did. And then it was trading at 48. So the spread now blew out to 193 on a risk of 36, $157 per spread. That's a 436% return. And that's a nice little trade, nice little profit to take home. So that's an alert that we did just really recently on that. Here's another one that we did. This was on Amazon. This was a long call condor. And this one here's kind of jumping through the what we did here. So we originally set that up on the 21st, okay? So this was set up as a condor, and then, we did some adjustments on the 24th, and then the 25th, taken off. It said here, Amazon long trade around 231.86. If long, the adjusted condor, 227.5, 230, 235, 237.5. Trade poised to go out max profit on close between 230, 235, currently up 143, $136, take some profit or wait, so I'm constantly updating you. Now these are just a few, but I'll send out alerts, updates all day long typically. All right, so here's where the trade was set up right here. And then we did adjustment here, and then it ended up with the, right here as it went out. So set the trade up. It was trading here on the 21st at 227.60. And then after the adjustments, everything done, we ended up here with a profit on the 25th. It was trading right there at 231. Okay, so that was this trade on Amazon. And we did this Condor. Okay, so long the 227 at 230 called debit spread, and then sold against that the 235, 237.5. So I had that profile. Okay, $250 wide spread, cost of the trade. After the adjustment, we had an adjustment that increased our price a little bit on this, and so we had a price of $105, potential profit 145, 138% return. Okay, so this is that one, and here's where it went out right there. So this was up, went from 105 to 248. So we were up at the end of the day on this one. Going out, we were up $143 a spread, 136% return on our capital risk at 105. Okay, so that was one that we did not too long ago on Amazon. And here's one that we did on Palantir. I showed you that one earlier. I'll just kind of flip through that one pretty fast. So we did this one. This was an alert trade that we sent out on the 13th, and then out of it on the 16th. So right there, that's one I showed you earlier. That was Palantir. And then here are the counter diagonals, and we do a lot of these. We've been doing a bunch of these lately, depending on the market condition. Markets have been kind of grinding up, so these have been good to do. So started this back in June of 2019 through yesterday. We've had 362 trades closed out, 259 winning trades, 25 break even, 78 losers. We're running 78% win rate, again, unaudited. Here are a couple of those trades that we've done recently. This was one that we just did not too long ago. This was on Dollar General. And again, this was a long call counter diagonal that we set up on the 5th of August, trade at 110.80. And then we did a couple adjustments on this one on the 8th of August, the 12th of August. And then we ended up into this trade with a long call butterfly free trade setup. So on the 11th of August, this went out up at 310 per spread on this free trade. So I'll just kind of quickly go over and review this. So we started this on the 5th of August. You can see here, it says here, new Dollar General long, trading at 110.80, daily cycle low, retracement reversal. I try to give you a description of what I'm looking at while I'm doing the trade here in a short description, but then sending these things out as fast as I can. Daily positive momentum, these are referring to my indicators. So that's showing the momentum is good, upside momentum cross, something I like to look at. I give you the target 1, target 2, know your risk, buy. Here's the first part, buy a diagonal Dollar General, the 15 August, 8 August calendar diagonal, 111, 114 call at 175. Now, the other thing I do is when you sign up as a member or an alert member, I give you what I call my cheat sheet, so you understand what these trades are, how to, the description, how to read the trades. Okay, these are sent out based on Thinkorswim. I copy and paste and boom, send these out as fast as I can. So this was originally trade up as a calendar diagonal. On the 8th, we did an adjustment here. I won't go through. We adjusted a butterfly, and then here it was on the 12th going out. Okay, so it was up at 115. And the butterfly we had on was 113, 118, 123. Sent out, make sure to take some profit, currently up around $290 per spread. Okay, so constantly updating these things to tell you to, either book some profit, lock in some profit, what you need to do on the trade. And so here is the trade setup. When we originally did this trade, it was trading right here. You can see the breakout. We had our cycle reversal, nice positive momentum. It was breaking this area here. That's your 50 simple moving average. So it looked like it had poised for a good move to the upside, which it did. And then we did an adjustment here, and here's the profit there. So this was Dollar General, originally done as a calendar diagonal call, and then adjusted it on the 8th and the 12th, and then ended up trading at 115. We had a free trade, and on the 12th, we had a profit up to 310 per spread on that free trade. Okay, so this is what that one looked like. This was a really good one. And so here's the trade setup. We ended up with this adjustment. So we're now long the 113 call, short the 118, short the 118, long the 123. So we had that adjusted call butterfly here, and we had this trade set up where we had zero risk. We were able to recover all of our debit costs on the different adjustments we did. You can see the spread width was then $500. See the strikes on our total adjusted risk now, a credit of $75. Okay, so potential to make $575 on no risk. Now we didn't make the full thing, but we had a pretty decent, profit going out. So this trade, we went ahead. I can't remember exactly what was happening, but we had profit right there that we took. And so this went from a $40 debit. Oh, in this situation, okay, this is before we made the next adjustment. We had 350 less 40. It was up $310 or 775% return. And then we had, here's where it ended up going out. So we did one more adjustment that we're able to adjust it into this free trade here. And so this was on the 12th. Now it's trading at 115.20 right here going out. So we weren't, didn't get it perfect, but pretty good, close enough, 115.20. And this went from, we had a credit of 75. This was at $235 per spread plus the credit that we had. So we were up $310 on no risk after the adjustments that we did on the trade. And then here's just one more. I'll just flip through this. This was on KRE. This was the regional bank ETF. We did this as a calendar call, calendar diagonal. We adjusted into, again, a lot of times we'll do these calendar diagonals and we'll, adjust these, that we call it the kind of the progression of the trade. We'll adjust it to either ultimately to calendar or butterfly, something like that, where we can really get our risk down to give us a huge return. So we did this one. This was on KRE. You can see where it's trading. It was starting to break this 200-day moving average. We had nice momentum. Now you can add my indicators again to your, your package if you want. And again, use this link here, Georgia, and then use butterfly BF15. Use that, and you'll get that discount. And you also add the indicators. So here's KRE trade, boom, and then we did this, and this one ended up with over 1,900% return. All right, because we adjusted this down to nothing, just some really great adjustments. So ended up with our adjusted trade here, a long the 62 call, short the 64 call debit spread after doing some adjustments, and then short the 65, 67 call credit spread. Okay, so we had this structure profile, and now we had reduced our risk down to $8, 8 cents, $8, $200 wide spread, potential to make 192. That'd be a 2,400% return. There you go. These things are possible. And here's where this went out for the profit that we were looking at right there. So this was trading then at 63.95. The original trade when we set it up was 59.88. After the adjustments, there we are. Now we had this trade from $8 to 161. So this was up $153 per spread. That's a 1,912% return. And just a few more. These are a few earnings trades that we've done recently. And again, these are super selective, even more selective than any of the others. Started this back in June as well, and this is through yesterday. We've had 145 closed out, 106 winners, 17 break even, 22 loser. We're running 85% win rate. All right, again, unaudited. here are a couple that we've done just recently. Here's one we did yesterday, or we did this one this week. We did this we set this one up on Thursday. This was on Affirm, AFRM. This was an earnings, what we call an iron condor debit spread. I won't go read through this whole thing, but this was sent out to the alert members. Okay, this was the trade for this earnings trade. And this is what we call an earnings iron condor debit spread. Very selective for this type of trade for Affirm. What it typically does big, huge spikes. And then yesterday, here it was at max profit, sent out this alert, take profit. This thing is, going to be a max profit trade based on what I sent out on Thursday. And here's that trade. I just kind of put this together real quick this morning to show you. So we set this trade going up or going out on Thursday. It was going out right here. So we set the trade up on Thursday, and then boom, one day later, here it was. We were looking for an explosive move up or down, and we got it to the upside. So this was when we set it up, it was trading at 79. Yesterday went out at 88.45. This thing was up to almost 100, but this was what we call the iron condor debit spread. And here's the trade that we did on this. So we had this sent out to my members. If you wanted to take it, these are just, if you want it or not, here's a trade that I thought might be good. So along the 83.85 call debit spread here, looking for a potential explosive move or explosive move to the downside, the 77.75, and it ended up here. So we had this trade at total risk of spread width of 200, cost of the trade 150. We make 50 bucks, 33% return in one day on this selective earnings trade. So that was Affirm. Here's one we did on Exxon Mobil. This was what I call a double lightning. This is one that we did a week back. This was on the 31st. Exxon was trading 98.15. We did this as a double lightning, a specific trade. I won't go through the details, but here it is going out to the members. Here it was the next day. This was set up on the 31st, taken off on August 1st. So this was a double lightning or double calendar. This was perfect. And these are the ones that we've done just recently. So this went from the spread blew out to 175. Our cost of this trade was 118. So we made $57 or 48% return on this. This was done for volatility collapse, volatility crush, a really cool strategy. And then here's another one that we did on Carvana. This was for a big rip to the upside. Carvana was trading at 337.46 when we set it up. Took it off the next day. It was trading at 377. So this was like Affirm. So got in here, blew up here, got out there for 60 bucks on the spread, 31% return. All right, so just give you a preview of everything, and then just one last look here. Please take advantage of it. I look forward to seeing you next weekend. And here's the link, special, put in BF15, and you're good to go. And let me know if there are any other questions.